Hello traders, good day everyone from wherever you're watching me from. My name is Segun, an experienced Forex trader, the founder and CEO of PipsCity Forex Academy. I'm experienced with the use of Elliot Wave principle, smart money concepts, demand and supply, and others, just to mention few. Today I will be revealing the greatest Forex trading strategy. I will also be talking about pre-section analysis and demand and supply. Please hit the subscribe button and like our video. Also turn on your notification bell so that anytime we make videos like this one you are watching, you'll be the first to be notified. Let's go into today's class. Good morning everyone. So this is a comprehensive mentorship lecture, and that if you actually don't understand this, probably think that you are gambling in the forex market. Alright, you need to understand this principle. You need to understand it as a forex. So if you want to call yourself, yes, you are a forex trader, you actually need to understand this. So we have so many strategies anyway, so it depends on you if you understand, but this is the basics. If you don't understand these basics, do you understand, then followed with your type of trading, like your type of analysis, you can couple this with your kind of analysis. But you just need, this is actually basics, but it's not basics like 101. Do you understand? It is basics, although this is an advanced class. All right, so now this is, we want to talk about pre-section analysis. It's very important. Pre-section analysis, we'll be talking about, and I'll be dishing out so many things here, so I just want you to concentrate. Yeah, so you listen. All right, now when we're talking about pre-section analysis, what I'm trying to say is this is a type of analysis whereby you project for the future. Now this is USD card. It's a very good pair. I like it because of the USD as the base, and their structure is always fine. They respect 70% or 80% of the time. The structure is fine. That I like the structure, and my analysis based on this particular pair used to come to play, and it's very easy for me to do analysis on it because of the USD. All right, now look at this pair. Now this is where the market is presently. So now let's do a quick analysis on this. Now you will see that you're having a push at a major area. You're having a push at a major area. You see this push down. You see this push. As small as this push is, this is an impulse. As short as that push is an impulse. You can't compare it with this kind of choppy market. You can't compare it with this kind of market. It's a push. Do you understand? So as short as it is a push. As short as it is a push, and before this push can happen, before all these pushes can happen, there's a good amount of volume that has been introduced to the market at that particular section, and that's why you need to understand section analysis. You need to understand capital market open, equity market open. So you need to understand all these things. All right, so now let's look at this. Let's zoom out. Let's look at this. Let's look at the time this particular boom happened. Now look at the time it happened. You can see 1 o'clock, and it continued until 16 o'clock. That is 4 o'clock. You can see it continued to there. Now why did it happen at exactly this place? Why? Do you understand? All right, go. So if you understand pre-section analysis, you understand why. So this is a 1 minute time frame. So you need to, it's not any time you get to the market that you must see entry. This is very important. If you begin to go into the market and anytime you enter the market you see entry, then you are gambling. Now look at this market. Let's do a good insight on why this happened. All right, so you see an impulse here. There's an impulse here, and there's actually a break of structure here. You saw that break of structure. So now this impulse, anytime you see an impulse an impulse must have a correction. Please, it's very important you understand. An impulse, like for example, this is an impulse also, and all this was the correction. Have you seen that? That was an impulse and all that was the correction. Now look at this. You saw that this is the parent impulse. This impulse in between the correction, they are the minor impulse. All right, and you can saw that it was also corrected. This minor impulse was corrected down to discount before this move happened, and still yet you see that this discount was the discount for this one also, and because of the merge, you saw this push. Now look at this. We have a break of structure here. This is an impulse. We need it to correct to premium. We need it to correct to premium. Now I told you, anytime we see something like this, we take your fib retracement to, where is my fib? Okay, this is my fib. Let me bring this down so you see. So now you take it from the tip to here. All right, you click on it and you expand. Yeah, make sure. Yeah, good. So you can see this is, you can see 0%. Then I started from here. Good. Now I told you sorry. All right, so now I told you, now this is the impulse. To measure the retracement, I told you, if you want to buy, make sure this retracement comes to discount before you buy. All right, so you buy at discount, you sell at premium. All right, so let me take my rectangle to. So I like, this is the medium, the 50%. I like to see my correction go deep down to most times, most accurately. I like it anytime, anywhere it is below 50%, 61.8 or 62% is good. But still yet, I like it when I confidently see it come down to 0.9%, from 0.75 to 0.9%. This area, this particular area, from this 0.75 to 0.9, I love to see it, come down to that level. Do you understand? I love to see it come down. So I have to highlight that level because that is the level I love to buy from. Now you saw that the market came to this point to sweep liquidity at demand. It didn't break it. If this particular market broke this particular structure, then it's something else. But it didn't break, it just swept it and it closed above. You can see it closed above. You can see it closed above, and we have a push, then a correction, then further push. Now you saw that the market, we have this first push, we have A, B, C, then we have the second push now. You understand? So to label, according to Elliot Wave theory, this is your A, this is your B, and this is your C. I understand that. All right, good. So that is not the point. That is not where I'm going to. What I'm trying to say is, it is around this discounted area already. So please note, if you have a single push, the first thing I want you to do is you label that as A. Do you understand? You must have a B. Sometimes it comes like this. Sometimes B structure comes in 3 waves anyway. B structure most times comes in 3. According to Elliot Wave theory, B structure comes in 3 waves. We can have a simple basic structure like this, 1, 2, 3, and we can have a complex structure like this, something like this. Do you understand? So this is a complex ABC structure. So where this is your B and we have another C, this will be your C, then you have a push. So this just, I'm trying to digress anyway, so I don't want to really digress. I just want to eat the nail on the earth. Now, so the market came down to discount And what happened? We have the push. Now look at the time this market came down. You can see the market came down at around so this was when the push started. This big push, you can see 1 o'clock, and it continued till oh God, what will I put this now? Continue until 16 o'clock. Until 16 o'clock, you can see it. Until 16, that is 4 o'clock. Alright, good. Now let's look at another structure. Let's leave this. Let's look at another structure. Okay, let's look at this. Let me remove this. I've done the analysis. Now let's look at this. After this push, you have a short consolidation here. Naturally, I would expect the market to come down, to correct this, because we have a lot of gap here. You can see fair value gap around this area. A lot of gap that needs to be corrected. You understand? But the market did this. The market just did this 1, 2, 3, then sweep, and we have something like this. You understand? To break structure and have more back. So I wouldn't have entered here. No, it's not. I was supposed to see let it come down before it moves up. Now, but the market presently, anytime you see something like this, the market must be filled. The market must fill up this. Now, what will I do now? I will just mark this out for future reference. Mark this out. This is a fair valued gap. This is a fair valued gap. I'll just mark it out for future purpose. Do you understand? So I would like to see the markets come into this point. Do you understand? Come into this point, take lead, and a further push up to the upside. I like to see it, and that is why this market is coming down, because it actually wants to fill up this fair value gap, then tap liquidity at this place and further push up. All right, so please let's go back to history. What I'm trying to explain here is the reason for some push. These are push that we don't want to be trapped in. These are push that we want to be involved in. Do you understand? So now let me go deep here. Now, for example, look at this market. Let me just push it. Look at this market. This is 10 o'clock. Now, you can see this market is you can see all this came down, blah blah blah, Asian section, blah 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 blah. And look at this London section. This is 10 o'clock. Let's look at the history. Okay, that's the reason why. Because there is a reference here. Have you seen that? So there's always a reference. Is either an order block or a sweep. There's always a reference. Just go left and you see the reference. All right. Okay. Let me start here. I just want to start. Okay. Let me start here. Let me start from this push, so you understand how many minutes. I don't want it to be too long, so you understand. So let's zoom out. Okay, good. Now let's look at the time this push started. You can see the push started 14 o'clock. That is 2 o'clock. And the reason for this push is because of the capital markets involvement. The capital market open, and that's why this move. Okay, now look at 1 o'clock. Let me zoom out. You can see this candle was 1 o'clock when New York session opened, but you see what happened. There was no push until 2 o'clock. Do you understand? When capital market opens. So now this 2 o'clock, 1:30 is a very important time. for New York section. Now, why would we be looking at this particular area? Why should we be looking at this particular area? That's why I was talking about pre-section analysis. Now, you must have had this as history or reference for this particular push. Do you understand? Now, look at this push. Look at this push. We have this push. We have a break of structure. Have you seen it? Telling us that is an uptrend. Do you understand? We already have a break of structure here, and we have the inducement that broke the structure. This is the inducement. The inducement is above the break of structure, so we don't take that as inducement. So this was the inducement before this break of structure. Do you understand? So that was the inducement, and that will be our reference point. Now, that inducement, let's take my fib. Where's my what are they calling it? Retracement. So I draw it out. Yes, from here to here. I drew it out from this tip to this 0. Have you seen it? All right. So I told you I love to comfortably see my push come down to this level, 75% or 90%. This area, just draw it out. Something like this. Good. Let me remove my fib so that the chart will be a bit neater. All right. Now you see that particular level commensurate with this inducement, because the inducement must be broken, must be swept. Do you understand? And you can see that I will have, even if this section has not even come to play, I will have marked that place that once I see it and it aligns with a section open, at least 3 hours after the section open, and I saw it come down here, do you understand? I will take it. Do you understand? I will take the buy because of it. As this is a push, that is 1. We have our retracement is below 50%, that is 2. The inducement has been taken, that's 3. Those 3 things is what you need. Do you understand? If you want to include your RSI, look at my RSI. My RSI is below, is at the over bot area. Yeah, so it came down already, and it's here. Then boom, once the capital market for New York is opened, and you saw this move 2 o'clock. And how many picks do you have here? It took just how many minutes to get to this place back? Do you understand? This is not your trade. This is not your trade. This is your trade. Do you understand? This is your trade. This is not your trade. All right. So now let's leave that. Okay. Now, I told you. So this move had come to play already. We need to see a correction. We need to see correction down. Do you understand? We need to see a correction. But you can see constantly the market has leveled at this area. At leveled at that area. Doesn't want to break. You can see that this is a sweep of liquidity and it closed above. You understand? So you just take your let's take this to draw a line like this. Okay, we draw it naturally. Okay, please, I'm coming, just hold on. Okay, I just want to see something. Okay, look at my fib. Look at my RSI. You can see that after this push, we have another extra push, and that extra push on the RSI was an higher high. So that is it. I just wanted to understand the strength of this particular push. Sometimes on the RSI it will be coming down on the RSI. So that's the reason why I had to check that. All right. So I will take my fib, my retracement to. I'll take my fib. Okay, from this low then to this to this place, to this. So you can see that first off, I'll be looking to sell around this area. I'll be looking to sell around this area. I'll be looking to sell around 75 to 90%. Do you understand? At least it's below. Now, first off, my confluence is this. Let me remove this fake so we have a clear picture of what we are doing. First off, you can see fair value gap. There's a gap here, and that gap must be filled. That's the first thing. But market can do whatever it wants to this market for you. Do you understand? So what did the market do? First off, I would have rolled this. I think the gap started from here. There's a gap. Okay, so that's it. Now, what did the market do? The market just tapped into. Have you seen it? Tapped into and went back, and this push happened. Now, immediately we have a sweep. I used to look out for this sweep. Immediately we have a sweep. The market doesn't have the incentive to come back to that region again. Please, I want you to note this. Immediately, anytime we have a sweep, if we have an uptrend and we have a sweep towards the demand level, the market doesn't have the incentive to come to that region again. All right, so what the market do is this. We have a break. Immediately after the sweep, we have a break of structure. So immediately we have that, we have a three-wave structure, 1, 2, 3. That's your A, B, and C. And that C came right down to where? Let's measure this. You need to measure this. It came right down to, should we measure it from here? Came right down. Naturally, I don't measure weeks, so let's leave it at this last point here. So the market did not break the structure. There was no break of structure because we even have weeks here. So the market did not break. The market came down to this region, and immediately what happened? We have a push, and that push you can just measure that push to be very accurate. Let's look at the time that this happened. You can see, look at the time it happened. It happened in a time that the section New York section is the liquidity has been reduced. You can see it in 19 o'clock. Okay, that's 7 o'clock, and you can see this push 8 o'clock p.m. So we cannot enter that market because that particular section, the capital market of that particular section is not. So this particular push is a retail push. So what did the market? You have to wait. That's why pre-session analysis is very good. You have to wait. What you have to do then is you do this. That's what I do. I come here, I measure the move. I take my feed, measure this move. Measure this move from here to here. Okay, good. Measure the move from here to here. From here to here. Immediately I measure them. Let me see this. I'm coming. Segun. Okay, that's 0%. Okay, good. Immediately I measure the move from there to there. Okay, good. I take my rectangle. Naturally, I like to see it from 75% to 90%. Okay, good. Immediately I see that Now look at this picture. You will have done this analysis because you would naturally you would have taken this buy, because this buy will still have to come down. We still have to come down again to the test. You understand? Because the section of that market is not open. So what happened immediately? I think I will stop here. What happened immediately was this push happened. What time? Have you seen it? 14 o'clock. Have you seen it? New York section. That is when the capital market of that currency is available, is opened. That is when New York Stock Exchange, that is when NASDAQ is opened, the second largest market in the world. Do you understand? And so that is why you must understand section analysis, pre-section analysis. You must understand it. Couple that with your with your trading, with your knowledge of what are they calling it? Your technical analysis knowledge. And this is, look at the move. Look at the move. Do you know how many pips this is? Oh God. Oh God. The move. It's more than 100 pips. It's more than 100 pips. And immediately when the section was over, we have a decline. All right, so that is that for that. Thank you and God bless.